Hi, this is Ken. Wells Fargo has lowered Tesla's price target to $130. Considering the current stock price, this prediction suggests a significant decline. Hearing this news, some might think, is Tesla doomed? But hold on a second. Why is Wells Fargo so pessimistic? And should we really believe this forecast? On the other hand, Morgan Stanley is recommending Tesla as a buy. Their perspective is entirely different. So, what explains this difference? Additionally, reports show that Tesla's sales volume has declined. However, at the same time, leaks about a new model have surfaced, fueling expectations for future growth. So, what will actually happen to Tesla stock? Will the decline continue, or is this a buying opportunity? In this video, we will analyze Wells Fargo's forecast in detail and provide an objective review of Tesla's current situation and future potential. At the end of the video, I will also discuss strategies for Tesla stockholders and potential investors, so be sure to watch until the end. Let's first take a closer look at Wells Fargo's forecast. Wells Fargo analyst Colin Langan has lowered Tesla's price target from $135 to $130. With Tesla's current stock price hovering around $250, this suggests a nearly 50% drop. Why such a pessimistic prediction? The three main reasons cited are declining sales, lower profit margins, and increasing competition in the Chinese market. Let's examine Tesla's sales performance. For the first quarter of 2025, Tesla's projected deliveries stand at 360,000 units. This represents a 7% decline year over year and a 27% drop compared to the previous quarter. In other words, rather than growing, Tesla's momentum has slowed down recently. Looking at regional data, Tesla's sales are indeed struggling. In China, sales have declined by 14% since the beginning of the year. In the US, January sales dropped by 11%, but the most concerning is Europe, where January sales fell by 45%, followed by a 41% decline in February, a drastic situation. Additionally, profit margins are shrinking. Tesla has repeatedly lowered prices, which has squeezed its profit margins. For example, price cuts on the Model Y have led to stagnant revenue growth and lower profits. Moreover, competition from local manufacturers like BYD in China is intensifying, and Tesla is gradually losing market share. Given these data points, Wells Fargo's $130 forecast has some basis. However, this is based on a pessimistic scenario. On the other hand, Morgan Stanley maintains a buy recommendation. Why is there such a stark contrast? In the next section, we will analyze Tesla's actual situation and more optimistic perspectives. So far, we've covered Wells Fargo's $130 billion forecast and the reasons behind it, including declining sales and shrinking profit margins. But is Tesla's future really that bleak? Or is Wells Fargo being overly pessimistic? In fact, there are positive aspects to consider. Now, let's examine why Morgan Stanley continues to recommend buying Tesla and what growth factors the company has. First, Tesla's sales in Norway and Sweden are recovering. For instance, in Norway, the Model Y topped the sales chart in March with 485 registrations, while the Model 3 ranked second with 267 units. In Sweden, the Model Y placed third in monthly registrations. This means that while Tesla is struggling in Europe overall, certain countries are already showing signs of recovery. Moreover, as I mentioned in a previous video, Tesla is developing its next generation affordable model, Model 2.5, which could have a significant market impact. This model, codenamed E41, is a compact vehicle based on the Model Y and is expected to reduce production costs by over 20%. Manufacturing will begin at Giga Shanghai, followed by expansion to North America and Europe. If this new model launches successfully, Tesla could gain a competitive edge in pricing and boost its sales volume once again. Additionally, Morgan Stanley highly values Tesla's AI technology and advancements in autonomous driving. Elon Musk has hinted at launching a new Robotaxi service as early as the first half of 2025. If the Robotaxi business becomes a reality, Tesla's revenue model could change dramatically. Of course, there are skeptics, including former Waymo CEO, who dismissed Tesla's Robotaxi claims as fake. While challenges remain, the long-term growth potential is a key point to watch. As we've seen, Tesla faces short-term challenges, but there are also factors supporting its long-term growth. So, what should Tesla stockholders or those considering investing do now? Let's explore strategies for the future. We've discussed Wells Fargo's $130 billion prediction, the reasoning behind it, and the positive aspects supporting Tesla's future. Now, what strategies should Tesla investors consider? In the short term, Tesla's stock may continue to fluctuate. Concerns like declining sales and increasing competition in China won't disappear overnight. The impact of price cuts on profit margins is another issue affecting earnings. Considering these factors, the risk of further stock declines in the short term cannot be ignored. If you're aiming for short-term gains, careful decision-making is essential. On the other hand, from a long-term investment perspective, Tesla still holds strong growth potential. If the new Model 2.5 is released successfully, market dynamics could shift. Additionally, advancements in autonomous driving and the potential launch of the Robotaxi business may open up new revenue streams. Looking at the sales recovery in Norway and Sweden, Tesla is not in decline across the board. Some regions still show strong demand. Furthermore, with the upcoming deliveries of the new Model Y, sales figures could see a significant boost. So, what is the best strategy? One approach is to stay prepared for short-term volatility while focusing on long-term growth. For instance, instead of buying all at once, consider using dollar cost averaging to gradually build your position. This way, if the stock price drops further, you can lower your average cost per share. Alternatively, if you want to avoid short-term downside risk, you could wait for the stock to approach $130 before entering. However, given the circumstances, I believe it's unlikely to drop that low. Instead, a strategy of buying on dips might be a more practical approach. Ultimately, your decision should depend on your investment time frame. If you're looking for short-term trades, exercise caution. If you believe in Tesla's long-term growth, view the decline as an opportunity. What do you think? Will Tesla's stock fall further, or is now the right time to buy? Let me know in the comments. Also, remember, investing is your own responsibility. Make sure to do your research and invest wisely. In today's video, we analyze why Wells Fargo lowered Tesla's price target to $130. The key reasons were declining sales, shrinking profit margins due to price cuts, and intensified competition in the Chinese market. However, Tesla is also working on the new Model 2.5, and sales are recovering in Norway and Sweden, showing positive signs. Morgan Stanley still maintains a buy recommendation, citing Tesla's autonomous driving technology and potential growth in the Robotaxi business. So, what's next for Tesla stock? In the short term, volatility will likely remain high, but in the long run, if you believe in Tesla's growth, this downturn might be a buying opportunity. Alright, that's it for today's video. If you found this content helpful, please give it a thumbs up. I post daily updates on Tesla, so if you haven't subscribed yet, make sure to do so. Thanks for watching, and let's enjoy life with Tesla.